Okay, welcome to the mortgage interest deductions section of our itemized deduction series. We are now in section 3 of our series. Section 1 was medical deductions, section 2 was the state and local tax deduction, and section 3 is the mortgage interest deduction. My name is Steve Boisvert. I'm a CPA with Gelman, Rosenberg Freedman, and we're taking a look at the changes made by the Tax Cuts and Jobs Act. So let's dive in. So here's just a screenshot of what the new draft 2018 Schedule A for mortgage interest deduction looks like. This is what you will take your mortgage interest deduction for, and this number will end up running to page 2 of your 1040. Under the rules from the old tax law, you could deduct mortgage interest on mortgages with principal balances up to $1 million without having to limit that mortgage interest. And you could also deduct interest on home equity lines of credit when the balance was under $100,000 without having to limit it. So for all intents and purposes, the total balance limitation was $1.1 million under the old tax law. Some other rules that the old tax law had: you could deduct mortgage interest on up to 2 separate residences. So you could have a primary residence and a vacation home. You could still do this under the new law, but with the new limitation that I'll show you in just a second, it may be harder to get the full deduction for that mortgage interest. Well, that's a summary of the key points of the previous law. But now let's take a look at the new law. Mortgage interest indebtedness is now going to be limited on loan balances over $750,000. And take a good look at this from 12/15/2017. I want you to take special note of this particular date. This is kind of our line of demarcation. Any new acquisitions after 12/15/2017 are going to be subject to the new tax law. That's kind of a weird date, but for the most part, the new tax law takes effect for 1/1/2018. But this is definitely something you need to be aware of. Any acquisition after 12/15/17 is subject to this new $750,000 threshold. So I keep saying acquisition indebtedness, and the question is, well, what is it? The Internal Revenue Code defines it as indebtedness which is incurred in acquiring, constructing, or substantially improving the qualified residence of the taxpayer and is secured by such residence. Okay, acquisition indebtedness. I was a little concerned about this. I understand acquiring, and I assumed constructing, but I was concerned that they weren't going to include improvements to the property. This is important that they included this. Substantially improving the qualified residence of the taxpayer. That's a big deal because you can refinance the house, and then if you put money back into the house, say you refinance it, you want to put a deck on the back or something that a new roof on the property. Well, the mortgage interest is still fully deductible for that substantial improvement. So the Tax Cuts and Jobs Act removes the provision for deductibility of home equity indebtedness unless the HELOC was incurred in the acquisition of the home. So for instance, say you're doing a 2-trust loan in order to purchase a house. You have your primary, maybe you didn't have enough money to put down enough money to actually be able to secure the house. So you put down 5% and there's a 15% home equity line of credit. Well, that home equity line of credit, which was used to help purchase the house, that's included in acquisition indebtedness. So that's just an important thing to note. It can be a little deceiving. It's like, oh, we've lost our home equity line of credit deduction for the interest on that particular loan. Well, you have if you took it out without including it in the acquisition of the home. If you have questions on that, feel free to email me. I'll give you my email address at the end of the presentation. That can be a little confusing. So this provision also changes back to the old rules on 1/1/2026. You can see here at the top of this slide, it says through 2025. It's through 2025 unless it's extended. So just be aware, throughout 2025, I'm sure we'll have quite a news cycle discussing whether or not certain provisions within the Tax Cuts and Jobs Act will be continued or not. Now, very important thing to point out. On acquisition indebtedness incurred prior to 12/15/2017, the old $1 million limitation still applies, and this is true for refinancing a loan that was incurred before 12/15/2017. So, in other words, say you bought a house in July of 2017, and you decide, you know what, we need to refinance this loan, and it's mid-July 2018. Good news, you still are subject to the $1 million threshold, even though the refinance took place after this line of demarcation, 12/15/2017. So the triggering event that uses the $750,000 threshold is the actual acquisition indebtedness. Homes acquired after 12/15/2017. Refinances of homes that were purchased before 12/15/2017 still get that $1 million threshold. And this only matters if your mortgage balance was over $750,000. If your mortgage balance was under, you don't really care. All right, so let's talk about these two topics of substantial improvement from the last slide, as well as any restrictions there may be on refinancing a mortgage on a property acquired before 12/15 and refinanced after 12/15/2017. So, three things to be aware of. One, substantial improvement adds value. Two, it prolongs useful life. And three, it can adapt the home to a new use. So, would adding a towel rack to the bathroom qualify as a substantial improvement? The answer would be no. Does adding a new roof, putting a new roof on the house, qualify as a substantial improvement? Well, I would argue that yes, because it prolongs the useful life of the home. If you didn't have the new roof, would the home be livable? No. Does putting a deck or a patio with a nice fireplace on the back add value to the home? I would say yes. So is that a substantial improvement? My argument would be yes, it is. So mortgage interest in relation to the substantial improvement would be deductible in that case. You refinance the house under the limitations of the property, of the mortgage, and there's interest on the new parts of the loan. Yes, that mortgage interest, as long as it is used to substantially improve the property, would be deductible on your tax return. The other caveat that I wanted to note was, are there any restrictions on refinancing a mortgage for a house that was purchased before 12/15/2017 and then refinanced after 12/15/2017? And the answer is yes. There is one limitation, and that limitation is that the refinance mortgage cannot exceed the amount of the original mortgage. So say you had a mortgage of $800,000 on the property purchased prior to 12/15/2017. the new refinance mortgage cannot be $810,000. I mean, it could be. You just wouldn't get any deduction for the interest on that $10,000 that it exceeded the original mortgage. So those are just two items to keep in mind when considering refinancing a mortgage. Okay, so as I mentioned on the last slide, we're going to do a timeline here to hopefully make this a little bit more clear. Here's our timeline. We've got a home purchased on July 2017. In July 2017, the loan balance was $800,000, and we've got on 12/15/2017 our line of demarcation. The homeowner wants to refinance the property in July 2018. All right, is there any limitation on the $800,000? Okay, so yes and no. It's still under the $1 million AGI threshold because the home was purchased July 2017. So in that sense, no, there's no limitation on the $800,000. As long as they don't increase, there can be no increase in the balance of this loan. The loan has to stay at $800,000 or less. And that's just going back to what we heard in the last slide, which says does not exceed the amount of the original mortgage. So maybe they've paid this down over the course of the year, and it's now $780,000 by the time they get to July 2018. But as long as this amount doesn't go north of $800,000, there won't be any additional limitation on the $50,000 of interest. So at the end of 2018, the mortgage balance, let's say, is $790,000, and he's paid payments of $50,000 of interest. The entire $50,000 mortgage interest will be deductible on his 2018 tax return. All of this is made possible because in July 2017 he purchased the house, and that's before our 12/15/2017 line of demarcation. So let's do our example on how the mortgage limitation works. Was this house purchased before 12/15/2017? No. Purchased in January 2019. So on our 2019 tax return, we're going to try and take mortgage interest deduction. The way that it works is you take the beginning balance plus the ending balance divided by 2. You take the average of the two, which in this case is $790,000. You take $750,000, which is our mortgage maximum principal balance deductible amount, divided by $790,000. This is roughly 95%. All this means is he's going to get 95% of the mortgage interest that he paid. So if we take $50,000, which is his total mortgage interest, times the 95% limited amount, he's going to get a deduction of $47,500. Now, if he had purchased this house in January 2017, he'd receive the full $50,000. Hopefully that makes sense. That's all for our topic today. If you have any questions and would like to get in touch, you can always email me at sboisvert@grfcpa.com. You can call at 301-951-9090, and my extension is 671. This is the third installment of our 5-part series on the changes to the itemized deductions from the Tax Cuts and Jobs Act. The fourth installment will discuss changes from the charitable contributions section of the Schedule A and potential tax planning opportunities you can use to reduce your tax liability in 2018. We will also be doing a fifth installment that discusses the unreimbursed employee business expenses, which has been repealed, as well as other 2% deductions. It will also discuss some of the changes to the casualty loss rules, as well as a brief description or topic about the removal of the 3% itemized deduction phase out. Thanks for listening.